Hi everyone, you're very welcome to today's webinar. We're joined by Tuohy from Hams Assist, who's going to talk to us shortly about smart strategies for tax efficient inheritance. We've been doing a number of these webinars over the last couple of months with a focus around preparing for early retirement and financial independence. And for people watching today, leaving a legacy and preparing your estate is a really important part of that. So Claire, that's what you're going to go through with us today. You might give us a brief introduction about your background and how you ended up in this industry.
So I currently work in Homes Valley Saxton Homes Assist. I've been specialising in this area, oh God, since 2000 and, oh no, I'm not going to say it for longer than I care to remember, but
well experienced.
well experienced. I have always dealt in this area. I worked in the United Kingdom for 7 years before returning here to Ireland. I am a member of the Society of Trust and Estate Practitioners and have a diploma in trust and estate planning in the UK. So I deal with the whole areas of wills, trusts, and estate planning.
Brilliant, and I assume have the kind of cross-border stuff as well, which is probably very relevant in Ireland and the UK.
Exactly. So that was really helpful from when I was working in the United Kingdom. So I do a lot between Ireland and England.
Brilliant. I suppose like just starting out as in people who are in their financial planning journey here, they're getting to the point in their lives now where they realize, I do need to start planning for this, and there's so much to go from. What are the kind of common mistakes that you see people when they start their journey out that, if they could avoid those mistakes, this whole journey becomes a lot easier?
Right. So, well, I see the main problem is that people fail to plan at all. Or they just leave it too late. So when we're talking about estate planning, what we're talking about is the orderly passing of wealth from one generation to the next, whether that be through your will or through a lifetime planning. So we're talking about passing assets in a strategic, considered manner. We're talking about trying to pass them in a tax efficient way with the objective of minimizing problems down the line, avoiding disputes, and trying to do all of this in a very tax efficient way. So if you have a plan in place, we can do it in that way. Whereas if you've no plan in place, then those opportunities to pass wealth in that way aren't always going to be available. And there's potentially difficulties down the line, disputes, or passing assets in a way that's not tax efficient. So not putting a will in place is probably the biggest.
It's a big one,
that's a big one. And look, it's one of the most important documents you'll ever put in place, but so many people don't have wills in place. So that would be fundamental to estate planning.
Just on the wills, I suppose people watching today might feel like as in a will sounds something like very complex, or you have to have a huge estate for it. Like they can be really simple, and that even a simple will can solve so many potential problems down the line.
Absolutely. And so there's this misconception, I think, about estate planning generally, right? That it's only for the very, very wealthy. But that's not the case. Everyone should have a will. If you have assets of any kind, you should have a will. If you have children, you should have a will. So if you have a child, you should be going out. One of the first things you should do is go out and make a will. Even for the appointment of guardians. And like people come into me and it might be very simple. They know how to divide their estate. But one of the difficult questions that they don't always know the answer to is who they will appoint as guardians if they die and their children are under the age of 18. And that can be one of the most difficult questions for them to answer. But it's really important to address that because, that could lead to difficulties amongst families. If something happened and there's no plan, there's no direction, and everyone has a different view then on what should happen or what you would have wanted to happen. So even for the children, for minor children, that's like a really important reason to have a will in place.
We often say when we're talking to families, like a lot of this is just about like leaving your family in a situation where they don't have to have a fight, or you're taking that risk off the table that there can be a dispute, isn't so just giving them complete clarity.
Oh yeah, totally. Like you see, if you die and you don't have a will, the rules of intestacy apply. And the rules of intestacy are great because there's a fallback.
Yeah.
However, nobody has ever come into me and said, I want to make a will in accordance with the rules of intestacy, because they're just not practical. And so like there's this misconception that, oh, sure, look, everything's going to go to my spouse anyway, or everything's going to go to my partner. But that's not necessarily the case. So if you have children and a spouse, then you die intestate, 2/3 goes to the spouse and 1/3 to the children, to be divided between the children. So if you think about it, like practically, if you've got children and they're under the age of 18, that's just going to be a bit of a nightmare, you know, trying to divide things up like that. But even if it's the children are over the age of 18, it can be really difficult, because nobody probably would have intended that it would be to be split in that way. And so then there has to be conversations like, will the children disclaim their interests so the spouse can take everything? And different people may have different opinions about whether that should happen, or may want to attach conditions to it. So can lead to like disputes or resentment. Yeah.
And it seems very similar to what we do when we're doing financial planning. We're trying to answer the question, what's the money for? And really that's it. It is like each family deciding themselves what they're trying to achieve from this, and then leaving to the experts to kind of build a plan around that. I think one of the very common questions we get asked then is around the transfer of assets. Like very, very simply, it's like, how can I transfer assets tax efficiently to the next generation? It's one of the big things that people want to know, particularly like with the families that we deal with who have a financial plan. They know they're in a situation where we're secure, we've done our plan first, we're not going to run out of money. Should we start looking at this now? Should we start moving assets now? So what are the ways they can do that tax efficiently, and are there kind of pitfalls around there, or things they should consider?
Yeah, so I suppose I would say the first thing you need to ask yourself if you're thinking about transferring assets during your lifetime is, if after having made the transfer, you're going to be sufficiently financially secure and independent without recourse to the person to whom you're transferring the assets. So for example, it's a family business. You need to just ask yourself the question, are you going to be okay here? And that's where like the likes of you come in here, because you'll plan all of this out and look at it and see if it's, if they're going to be okay and independent. And that's going to be really important. But the other side of it then is the personal side of it, and the fact that when you transfer assets, you lose control of those assets. Like, so especially now for like a family business that someone has been used to running and being in control of it, and now they're transferring it outside of their control. And as soon as you make an outright gift that goes outside of your control, it's subject to external factors. So you might have every faith in your child, but there's numerous issues that could arise, like divorce or succession rights and all of that, and the asset is gone outside of your control. So it's important, if someone is transferring assets, just to make their peace with that. And I suppose what I would say, it's important to have a good team around you. You need to have a good team looking at it from a financial perspective, from a legal perspective, and from a tax perspective. And to be looking at it at an early point in time, because there's lots of tax reliefs and exemptions out there, but you need to fit within the legislation and fit within those reliefs. So that can sometimes take time. So it's just getting the advice early, and particularly the tax advice.
And the tax stuff as well. So that is like, there's everything kind of a knock-on effect off each other. Like, so when you're gifting assets, there probably are some big tax considerations. What are the main things people should be thinking of there? And even just like in terms of the threshold, so that they don't go over, create a tax liability immediately, if that's what they're considering.
Okay. So with the lifetime transfer of assets, you are going to be thinking about the three tax heads. So the first is capital gains tax, second is stamp duty, and the third is capital acquisitions tax. So capital gains tax, that arises where you dispose of an asset for a value that is greater than the value you acquired the asset for. So the rate is 33%. If you're passing assets in your lifetime, it's always going to be a consideration if it's property. If you're passing those assets through your will, there's no capital gains tax.
Okay.
So that's just something to bear in mind. So there's a free uplift on death if that asset is
so
passed.
If you're dealing with a particularly elderly situation, like a couple or a person, it might be worth waiting or can be patient and waiting. Where if you're in your 40s and you're trying to take care of younger kids, do you want to wait that long? You know,
exactly. So it very much depends on the circumstances. Yeah. And like, so at the moment, you know, no CGT payable on death, but that could change because I think on the Commission for Taxation, they did flag that.
Okay.
I know. Yeah. So shock horror, but but at the moment, that's the situation. The next one then is stamp duty. So stamp duty, it's the recipient, the person who acquires the asset that's going to be paying stamp duty. And there's different rates payable depending on the type of asset in question. And then capital acquisitions tax, that's the big one. So when we're talking about estate planning, whether through lifetime or whether through your will, capital acquisitions tax is always the one that you're going to have to think about. The CGT and the stamp duty, they're both lifetime taxes.
Okay.
The capital acquisitions tax, that applies whether you're passing assets on during your lifetime or on death. And the rate of tax is 33%. And how much tax you pay then depends on the threshold that's available.
Okay. Different and they recently went up in the last budget.
They did. They went up. So at the moment, it's the Class A threshold, which is the threshold that applies that from a gift from a parent, that's 400,000. Class B threshold then would be if you were receiving a gift from like a sibling or a grandparent, and that's 40,000. And then Class C, then that's anybody else, and that's 20,000. So yeah, they went up there recently. They'd been like stuck at 335,000. And
a welcome change, I suppose. And there was a few things like that in the last budget. I was going to go back to one thing you mentioned earlier on about retaining control. If you gift an asset like that, that's over. But are there things you can do where you want to pass assets to the next generation because you don't want to wait 30, 40 years, but you want to retain control? So you might have a young child or a young adult that, you know, how would you put assets into their name tax efficiently, but make sure that they can't spend that money or have too much fun with it?
And like, as you said, like that's the big concern, isn't it? That once you transfer assets, you're losing control. So one option is to gift assets, but put them in a family partnership structure. So that would be where you gift assets outright to a child or to a number of children. However, you put a family partnership agreement in place, and that regulates the terms upon which the assets are held. So you retain control, the parent retains control by virtue of the terms of the partnership agreement, but most of the assets, the equity would belong to the child. So that's a way of retaining control, but also transferring the asset to the child, and doing that in a.
If you were doing that with like properties, for example, how would the rental income be treated then, or do you have options on that?
Yeah, so look, the great thing about the family partnership agreement, it's for you to design it and for you to dictate what the terms would be in terms of capital and income. Yeah.
So you could have a situation where you're putting the asset into the kids' names, but the parents potentially could receive the income from it.
Yeah.
So they don't have to worry, are we going to run out of money if we transfer this potentially?
Yeah, exactly. So it's great for property actually, because, you know, you could buy, so you could use up like the threshold of, say at the moment it's 400,000. And say if that property like increases up to 800,000, the growth in the asset, you've already gifted it to the child. So they benefit from the free uplift. Whereas if you had waited for your will and to pass that on the will, and the asset is 800,000, obviously then it's going to be taxable. So it's really good for assets that you suspect are going to increase in value.
For families who like that, this is something that is becoming quite common with the families that we deal with. If they're doing it for younger children though, is there a concern that what happens when the parents die then? you know, what are the other options? Because do the kids then just have outright ownership of that or control of that, or?
Yeah, so you would put all of this into the family partnership agreement, that you have managing partners who are making the decisions in relation to it. So you could put provision in for what happens on the death of the managing partner.
Okay.
Yeah, so that somebody else can step in and, you know, make
Yeah.
the decision. So yeah, it all doesn't fall off a cliff when someone dies.
Well, a very common question we get asked about trusts a lot as well. And like one of the common misconceptions we see around that is people kind of thinking that I put my money to trust and there's no inheritance tax, no penny, and it's very tax efficient. Not necessarily the case, but trusts are used to solve very specific problems. And would you just like talk to us about them? What are kind of the problems that people might have to say a certain type of trust might be suitable for that?
Yeah, yeah. Yeah, so there is the kind of a misconception that if you put something into a trust that you have no tax to pay. And we often get a lot of inquiries about that. I want to put a trust in place because I don't want to pay any tax.
Yeah.
So that's not necessarily the case. Now, they can be quite useful for planning purposes and for deferring tax, but they don't in themselves mean you don't have tax
Yeah.
to pay.
Okay.
So, but we use them an awful lot because they just offer a lot of practical solutions. So there's three types of trusts that we would use. The first is a bare trust, which is a very simple type of trust. And where you'd commonly have that would be if you came in to me and you said that you wanted to leave everything between your three children, but they're all under the age of 18. So you can't pass a property to a 12-year-old. So in
Okay.
those circumstances, you have to appoint trustees that would hold the assets in trust for them until they reach the age of 18. And then when they reach the age of 18, the trustees then transfer the assets over to the children. And if you're putting something like that in your will, then you usually put provision to say that they're entitled, that the trustees are entitled to pay income to the child for their maintenance,
Okay.
education, or benefit while they're under the age of 18. So it's not like it's totally ring fenced and it can't be utilized.
Okay.
So that would be,
That might be for like maybe smaller assets or things like that.
yeah,
If it's
yeah,
18, kind of when it comes to
exactly.
an
And a lot of people will go with that. There's another type of arrangement then, which is a discretionary trust. And we use these quite a lot. And I think these are particularly useful if you've got very young children. So with a discretionary trust, you are appointing trustees. Say, for example, in your will, you appoint trustees and you leave your entire estate upon discretionary trust to the trustees. And the trustees then have complete discretion as to how the funds are applied. So you would name the beneficiaries or a class of beneficiaries, say all of my children. And then the trustees then make the decision as to how the income and the capital is applied. They decide, you know, when they should get income, when they should get capital, when to wrap up the trust, whether to keep it going.
Okay.
So they're like stepping into the parents' shoes and they're making the calls that the parents would have made if they were around.
Okay.
So that's very useful where you just don't know what the future holds. So you're just picking people that you trust to, you know, step in and make those decisions for you. So that's
it's not like all that the horror cases that people worry about is like, that it could be addiction, it could be divorce and things like that. It can literally be like, you haven't decided yourself yet.
yeah.
Or the kids are too young to decide when you want to get it.
Yeah.
So you're deferring that to someone who is a trusted expert
Yeah,
to manage that.
exactly. And people you trust.
Yeah.
And that has to be the big thing that, you know, and what people do then, say, particularly now for couples and they've got young children, is they leave what's known as a letter of wishes. So a letter of wishes is like a document that you get. It's like a roadmap for your trustees, and you set out how you would like them to exercise their discretion. So you kind of sit out, you know, say, ideally, I'd like you to be able to treat the kids equally. Ideally, I'd like you to wrap up the trust as soon as the youngest reaches 21, because that's good for tax consequences. You know, however, if you think there are compelling reasons why it shouldn't be wrapped up, you know, then don't do so. Don't let the tax tail wag the dog, you know. So it's really just kind of setting out your wishes so they have, you know, something to refer to. It's like, you know, what would Claire have wanted? What would Cian have wanted? So they just have that bit of a roadmap, and that's confidential to you as the trustees. And it's not binding. It's just there as a guidance.
Okay.
So yeah, so that's just a common solution to the situation where you've got very young children, you don't know what they're going to turn out like.
Yeah.
But the discretionary trust would also then be used for what you referred to earlier on, is you may have children who have addiction issues, or are impecunious, and have had difficulties in the past.
Just immature.
Yeah, yeah, exactly. And you just, to maybe give them an asset outright would be very damaging for them. So they instead give it to the trustees and let the trustees see how they're getting on. So instead of giving them $1 million to go off and do what they want with
exactly.
it, that they'll go, no, what we'll do is we'll buy him a house, he can live in the house, we'll give him a monthly income, just to give them that flexibility. So, and where we'd also use a discretionary trust if there's a disabled beneficiary.
Okay, yeah.
Yeah. So, if there's a disabled beneficiary or a child who's vulnerable and just wouldn't be able to manage an inheritance themselves, then you would settle it on trust. So the trustees would essentially be minding it for them.
It's like, look, most families we deal with, like the idea of transferring some assets tax efficiently is very appealing. The idea of transferring a lot of assets isn't. So they want to generally, it's like, give them enough money that we can help them, we can set them up, but not enough that it can actually ruin their life. Like, so maybe they're using the small gift exemption to help them build a house deposit. But over and above that, generally people don't want to see young adults receive 50, 100, 200 grand, or in assets or in cash, so this is very important stuff. I so kind of moving to the end, at some point in time, the tax has to be paid. So CAT has to be paid. And let's say, whose responsibility is that on? And particularly in the States where it might, so we talked about like property and family partnerships, there mightn't be a pile of cash there if it's 33% to pay that. So what kind of options do people have? When do you have to do it? Who's responsible for paying the inheritance tax?
Okay. So in Ireland, capital acquisitions tax is a recipient-based tax. So it is the beneficiary who is responsible for paying the tax. So if we're taking a situation where somebody has died, a grant of probate is going to have to be taken out in their estate. And that involves an application to the High Court for this grant, which is essentially a license to an executor to deal with an estate. As soon as that grant of probate is taken out, it triggers what we call the valuation date, which is the date the clock starts ticking for the payment of capital acquisitions tax. So you're up against a clock, and if the beneficiary is up against a clock in terms of paying the capital acquisitions tax. So it can be a real problem if you are, asset rich but cash poor. What the Section 72 policies, that's a policy you can put in place that pays the beneficiaries a tax essentially, and they're not then taxed on that. So
it's a life cover policy that you're ultimately, the life assurance, what's going to pay out, and it's there readily available to pay that in that CAT bill.
Yeah, exactly. And so there's great peace of mind in knowing that that's there for the beneficiary, and they're not going to have to scramble around trying to raise a loan or sell assets in order to pay the CAT bill. I mentioned discretionary trusts earlier, that they can be quite useful as well, because while an asset is in a discretionary trust, there is no CAT to pay. So while it's in that trust structure, it's sheltered from CAT. It's only when the asset is appointed out of the trust to the beneficiary that the CAT becomes payable. So they're often used to defer the tax until the circumstances are right.
Someone who has a particularly illiquid state, like you're talking about like kind of multiple properties, there's a lot of money there, or a lot of assets there. That kind of almost seems like a must, because like if you're in a situation where you're having to come up with money in a 6-month period or a 3-month period and it's not there, you really want to avoid a scenario like that.
Yeah, absolutely. Discretionary trusts are quite useful for that type of thing. They're quite useful if there is reliefs out there, potential reliefs out there, like business property relief or dwelling house relief, because you have to have certain periods of like occupation for dwelling house relief, certain periods of ownership. For certain business property reliefs, you have to have certain ownerships and shares and that types of thing. So we've seen discretionary trusts work quite well because the beneficiary may not qualify for the relief at the date of death. But
Okay.
if we wait, you know, and get all of the things in place and maybe say move into that house for 3 years, and then after 3 years we'll appoint it out to you, and then
Okay.
it can be appointed out completely tax-free. It's even worth $1 million if
Okay.
everything. So yeah, so they're really useful for that type of thing.
Brilliant. Yeah, I suppose maybe a very brief summary, like, is anyone starting their journey going through this stuff now or has questions, like, what are the kind of 1 or 2 things the first things you say this is what you should do if you're getting started?
Okay, so it's probably not going to come as any surprise, and I'm going to say put the will in place. Yeah, like just do that very basic thing. Ring the solicitor. Like, even if you have not settled on what you want to do, just make the appointment and, you know, talk to your solicitor, and you may actually come out with a solution. Like, for a lot of people, they'd put it off because they actually don't know how they're going to deal with a certain situation. And sometimes it's just somebody else looking at it from a different perspective. So just, I think
it's in the important but not urgent category. And it's not urgent until it is.
Look, nobody likes thinking about it. Nobody likes thinking about their own mortality, or, you know, what we do, and, you know, the kids are left behind. Look, of course, it's not nice to think about, but you have to do it. Like, so just make the appointment, just kind of, you know, just take that first step. And if you have a will in place, go and review it. Like, there's nothing worse than seeing an out of date will. You know, it could have been done 20, 30 years ago. I recently had a will that it's a substantial estate, and the man had actually divorced his wife, but he's left everything to her. So so really important to keep the will updated and change it as circumstances change, you know, and return to it. So that's really important. Do the will, keep it updated, consider tax planning. If you consider lifetime gifts, consider using the small gift exemption. I haven't really speak about that, but you can give €3,000 away. Any one person can receive 3,000 from any other person during their lifetime. So that's
it's a quick win. Like, you can do it.
It really is, and it might like seem small, but when actually over, say, a period of 10 years, you know, that's 30 grand. And if you had 2 people giving, like, say, 2 grandparents giving that substantial amount,
it's like a house deposit sorted for kids and grandkids.
Whereas, like, if you just left that in your will, current threshold for, say, grandparent and a grandchild is like 40,000, so it would be taxable. Whereas if you can give that little bit away every year, that's another great way. So I'd just to probably conclude by saying, you know, don't leave it too late, and just start off early and just see what your options are, and, you know, get a proper team around you. You know, get your financial advisor, your tax advisor, your solicitor, if you're thinking about doing substantial transfers.
Brilliant. Thanks very much for that really comprehensive. I suppose for everyone watching today, if you're interested or intrigued by anything that you've heard, you can contact us. You can contact Claire. We'll have our contact details up on socials after today. Or if you're watching this on YouTube, they'll be in the comments below. So look, we'll let you all get back to your lunch. Thank you very much for joining us, and have a nice day. Thank you.